Yo, welcome everybody to day 5 of the Nick Graves Trades Bootcamp. Today, we're going to be talking about a very, very important concept, which is liquidity, and how to use it. I use liquidity in every single one of my trades, whether it's high time frame, low time frame. Obviously, most of you know what liquidity is, but I don't think a lot of you know specifically how to use it, and kind of like what we're looking at. So to start off, liquidity are just basically like swing highs and swing lows in the market. So like right here, this is like liquidity. Right here, this is liquidity. Right here, this is liquidity, and then like right now, we're technically making liquidity because this is like the most recent swing high. So this is where you can kind of like anticipate and look for like reversals, right? What is liquidity? Liquidity is literally just orders resting above this level. So think about it. Orders got filled right here. We reversed off of it, but the orders that didn't get filled are still resting here. So what you can anticipate is some sort of like sweep and then a reversal off of that, right? But I really want to teach you guys how to use liquidity because this is a full video on liquidity. This isn't just going to be going over the basics. This is going to be going over how to trade with liquidity, right? And there's liquidity on every single time frame, like I said. So if we kind of go back to like the daily and look at like what we're in right now, or even like the weekly, right? What we just did, we mitigated a weekly fair value gap. So either we're going to completely reverse from here, or we are just going to continue higher, right? It really just depends on the fact of what we want to do. But we also swept liquidity. What is this? Right here, this line that I just drew out is the top of the fair value gap. But if we scroll all the way over and we really can want to see what it is, this line is just liquidity, guys. It's just liquidity. Because think about it. The fair value gap is a 3 candlestick pattern, like I taught you guys. All this is made up of a weekly fair value gap. This low is the low before the extension up that created the gap, which lies in here that we marked out, right? Because this is the swing low in the gap. So we can expect this swing low to be swept out, which we just did and reversed off of. Do you guys see how that works, right? It's a weekly fair value gap, okay? This is like the fair value gap. This is the low that created the fair value gap. What can we expect? This liquidity to be swept, orders to be filled inside the fair value gap, and then we continue higher, right? And you can see the reaction we get off it. We sweep the liquidity, we reverse, and now we're going higher, right? But not only does liquidity have to do with high time frame, we also can use low time frame. Example, today when we're looking for or yesterday, yesterday. I was looking for longs up into data high, right? I wanted to see this get swept out, but what I failed to realize was we had these relative equal highs. I'm not going to label this thing as a rejection block because this is not a rejection block. It didn't sweep anything of importance. It didn't mitigate anything of importance. It is just a wick. But you're able to use low time frame liquidity in order to take trades. Look right here. We have 1 minute highs, relative equal highs resting above. I didn't expect a reversal up here, but looking at this hindsight, this was a clean short. Because why? We sweep out liquidity, we fill all these orders resting above, and then we continue lower. I mean, look, like you can see this everywhere, right, guys? Like you can go anywhere. But a really, really clean example that I wanted to show you guys was Thursday, Thursday's market open. Go to 9:30 right here. I wanted to basically see some sort of or wait, sorry, it was Wednesday. Let's go to Wednesday because Wednesday had a very, very clean Judah swing market open. Yes. One, two. Wait, I lied. It's Tuesday. Sorry. Hold up. Okay, Tuesday. So you can see here, market open. What do we have? We have liquidity right here. Okay, guys? We have 1 minute liquidity. But what is inside of this 1 minute liquidity? Oh, it's a 15-minute fair value gap right here. So this wick right here, this top of this 15-minute wick is the 1 minute liquidity. We go to the 5-minute. I wonder what the 5-minute is. Oh, guys, it's also a 5-minute fair value gap right here, as you can see here. All we do is we sweep the highs, right? We sweep the highs. We mitigate. These are the resting highs that are right here. We use this as liquidity because it's resting below. And then we enter short because why? We sweep 1 minute highs inside of a 15-minute fair value gap with a very, very strong draw right here that's very clear and obvious. And look what happens. We tap in, dump down over 160 points, and you hit TP instantly, right? You're able to use low time frame and high time frame liquidity together, right? Because right here, this is an hourly low. And how do I know that? Because I've been trading. I don't even really need to look at the charts. But that is an hourly low. Let me go to it. All right, I'm sorry. Yeah, right here. This is like your, I guess, your so-called hourly low. Boom. And this is like the clear and obvious target that we are looking at, right? So very clear and obvious hourly low right here inside of a very, very big data fair value gap. This entire move right here, the 600-point move. But yeah, you see what happens? We fill a 5-minute fair value gap. We sweep 1 minute liquidity, 5-minute liquidity, also fill a 15-minute, and then we get a reversal down to the sell side. And then what do we get on 30-minute? We get a sweep of like this. We never close below, and then continue higher. The next portion of this video, what I want to talk about is candle closures in liquidity sweeps, because I trade a specific way when trading these liquidity sweeps. And I trade, I guess, the turtle soup method, if those of you have heard about it, right? Turtle soup is basically just catching the high or the low of the liquidity sweep. So in this particular trade, right, candle closures are very, very important, and you really need to understand what candle closures mean, okay? If you're looking for a true liquidity sweep, let me delete this. You never want to see a candle closure above the high on the higher time frame. Lower time frame, it's fine, because think about it. In this specific scenario, this is a 1 minute high. This is the market open, Judas swing. We take out this high, but we close above it. But you have to put it into perspective. On the 5-minute, it's the same exact thing. But instead, we don't close above it on the 5-minute, which gives us more confidence to go short. Why is this? Because in each 5-minute candle, there's 5 1-minute candles. So just because one 1-minute candle closed above this high doesn't mean the actual 5-minute will. So as soon as I see on the 5-minute there's not a closure above this high, that gives me even more reality to go and use it. And then also this becomes your rejection block, technically. And then you can see the 1 minute, as soon as the next 1 minute opens, after the 5-minute rejection block is created, look what happens. The 1 minute comes up, sweeps out, I guess, this 1 minute high. It's a 30-second high as well, and then hits the rejection block and then continues lower, right? Candle closure is very important, but I want to talk about vice versa when you know a liquidity sweep isn't true, okay? I want to show you guys this. So on high time frame candle closures are the single-handedly most important thing to use when looking for like your true bias, right? So look, give this case scenario. So we have I guess this high right here, right? This is a very, very important data high that I was looking at to be swept out. We never closed above it, and then look what happens. We wick down over 200 points after not closing above it. But look what happens when we close above it. We go up another 180 points, and you can find examples of this almost everywhere. But again, the higher time frame holds more power. Look at this, guys, right here. We sweep a very important high inside of a 4-hour fair value gap. We never close above it. Look what this is, instant reversal. I go to the hourly, same thing, never closed above it. I go to the 30-minute, same thing, never closed above it. 15-minute, same thing, never closed above it. I go to the 5-minute, same thing, never closed above it. So like you can see how closures are so important when using these, because if you're getting candle closures in specific areas that you want to see reversals from above the reversal point, then most likely it's invalid. That's how you're able to close out of trades early, if you're getting closures above these highs or lows that you're looking to take a sweep off of, right? Another candle closure case scenario. Look at this. We go to the 4-hour. This is a resting 4-hour low inside of a fair value gap. Look what happens. We sweep it, fill orders, reverse, and then off of this sweep, we never close below it. We pump up 400 points, right? Like this stuff works, guys. I promise. Like candle closures are very, very important. Like you can find candle closures anywhere, but again, the high time frame candle closures mean more than anything. Because those really tell you what the true sweep is going to be, right? Like case scenario here, I'll show you some more examples. Like this happens everywhere. Look what happens, guys. We have liquidity right here inside of a 4-hour fair value gap. We literally go, I don't know, maybe 7 points into it, never close below it, get an insta reversal of, I don't know how many points. How many points is this? Yeah, like 1,000 something. And then again, look at this. We have resting liquidity right here. Look what happens. We sweep it. We never close below it. Insta reversal. But now this becomes liquidity. So we sweep this, never close below it. And look, insta reversal. Like candle closures are something you guys really need to start to pay attention to because it will completely change your thought process on understanding when to trade. But again, candle closures are also very important on the 1 minute as well, especially when taking like set trades. When like the market opens and you're kind of looking for specific levels to get hit, right? Case scenario here. Look what happens. Boom. Never get a close. This is market open today. We never got a close above this. So I was like, okay, cool. If we inverse this, then like we're going short. We inverse it and then immediately pumped up. But then look what happens, guys. We get a closure. Oops, what the heck? We get a closure above this high with this candlestick. Now this entire thing becomes your order block. And then look what happens. We come down, fill orders, and then continue higher for another 170 points. As soon as we get that closure above, this becomes the order block. Look at this. These orders get filled and then we continue higher, right? You're able to use that to your advantage, right, guys? But yeah, that's all I have for the video. I hope this really made sense to you guys on how to understand like liquidity and where like orders are resting, how to understand candle closures, all the above. But yeah, that's all I have for you guys today. I'll see you guys in the next video tomorrow. Love you guys. Appreciate you guys. Peace.